Welcome to Pro News Weekly. Let's dive into the weekly updates on the financial markets. Last week, the dollar index hit a two-year high before pulling back. The fundamental trigger was the ceasefire between Lebanon and Israel. Technically, it looked like a correction after testing the upper boundary of the two-year trading range. At one stage, the dollar index retraced 61.8% of its rally since Trump's victory and 76.4% of the entire rally from the late September lows. This suggests that the recent decline may be a tactical retreat before the dollar makes another move toward new highs. The bullish outlook is supported by the Fed's policy shift, which is leaning less hawkish. Earlier in the week, markets expected the Fed to leave rates unchanged in December. However, by the end of the week, those odds had dropped to 30%. Still, caution is warranted. U.S. household income grew by 0.6% in October, outpacing spending growth at 0.4%. These figures point to robust consumer demand. Additionally, the pending home sales index jumped 5.4% year-on-year, its highest level since May 2021. Meanwhile, the core personal consumption price index accelerated to 2.8% year-on-year, up from the lows of 2.5% in June and July. This appears to mark a new wave of growth. What's particularly concerning for the Fed is that this rise is driven by higher inflation in the services sector, which is historically difficult to bring down. After falling as low as 1.0340 last week, the Euro-USD spent this week fighting its way back above 1.05, which is a local victory for the bulls. This rebound has been supported by a shift in tone from the ECB, which is adopting a less dovish stance. Given the weak economic data, this appears to be an effort to stabilize the euro from further downside. The single currency has also benefited from easing tensions in the Middle East and the dollar's corrective pullback. However, political uncertainty in Germany and France, where the rise of right-wing parties threatens to have a serious impact on policy, is adding to market jitters. In such circumstances, investors prefer to stay on the sidelines. All the main political issues that have been dragging the euro down for the past 2 months remain unresolved for now. On Tuesday, Trump threatened to impose tariffs on goods from Canada and Mexico on his first day in office. As a result, the Canadian dollar jumped 1.4% to a 4-year high above 1.4070. Since the early 1970s, USD CAD has only traded higher during periods of extreme oil weakness, and the last two peaks were in 2016 and 2020. Oil is no longer that cheap, but the Canadian dollar is clearly entering a period of turbulence. U.S. markets have a shortened schedule this week, with a full closure on Thursday and an early close on Friday. The S&P 500 has been creeping higher, but has only marginally updated highs at 6,035. While a 0.5% gain on the day sounds boring, such momentum tends to be more reliable than rallies and subsequent pullbacks. The index has been in an uptrend since last October and is now at the top of that range. The Dow Jones appears to be accelerating, which is appealing given the strengthening dollar and revised interest rate expectations. Last week, the index climbed towards 45,000. The VIX Volatility Index is back below 15. It has been rising steadily since July on political risks and the Fed's shift in the monetary policy cycle. Gold has faced pressure this week, losing around 3% amid the ceasefire between Lebanon and Israel. However, buyers have stepped in near the $2,600 per troy ounce level, a key support zone that held in late September and early October. Technically, gold's failure to stay above its 50-day moving average signals that bears still hold an advantage. If the price breaks below $2,600, sellers may target the month's lows near $2,540 in the short term. Looking further ahead, the long-term target appears to be $2,000 per ounce. However, in the current environment, A cautious, step-by-step approach seems more practical for traders navigating this downward momentum. After a sharp correction late last week, the crypto market has shown signs of recovery. Total market capitalization dropped from $3.4 trillion to $3.15 trillion at its low, largely driven by profit-taking from the strong rally since early November. However, this pullback has eased short-term overbought conditions, creating the potential for further gains. The Cryptocurrency Fear and Greed Index has spent most of the past 3 weeks in extreme greed territory, reflecting bullish sentiment. Bitcoin's decline, which dipped below $91,000, was driven by profit-taking and broader market caution. Yet, strong gains mid-week suggest these pressures may now be easing. Altcoins are gaining momentum, with the altcoin seasonal index climbing to 61, its highest level this year. This shift highlights traders moving from Bitcoin to other cryptocurrencies, setting the stage for a potential market-wide rally. While altcoins are likely to drive the next phase of growth, Bitcoin's path above $100,000 remains firmly in view. On Tuesday, Switzerland will publish its Consumer Price Index. Here, annual inflation has slowed to just 0.6%. The Swiss National Bank is aiming for an inflation range of 0 to 2%. A further slowdown in the CPI sets the stage for additional monetary easing. Some observers were recently surprised that the head of the SNB is allowing negative interest rates in the future. The policy rate is now at 1% and may be cut further on the 12th of December. The latest inflation data will determine whether the move will be 25 or 50 points. Much of the focus in the new week will be on Friday's U.S. employment data. October was very problematic due to one-off factors such as strikes and a hurricane. As a result, the economy only added 12,000 jobs. All eyes will be on whether the labor market will post a double-digit gain or maintain its growth rate. Strong data is positive for the dollar, but could also support equities. Canada will release its employment figures at the same time as the U.S. Unemployment has risen from 5.7% to 6.5% since the beginning of the year, despite a decline in the labor force participation rate. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.